I'm Charlotte McLeod with the Investing News Network, and here today with me is Don Hansen. He's a private investor who's been investing in the gold and silver mining industry for 21 years now. Don, thank you so much for joining me online once again. It's great to have you back.
Well, it's great to be back.
Really nice to be speaking with you. And I'll just add some context for our viewers right now. This is our third interview so far on your gold and silver stock analysis. I do recommend that people go back and watch those previous two interviews if they can, because it has a lot of good information on your due diligence process. And then actually for today, we're going to follow up on one of our previous conversations where you shared about the relationship between the gold price and gold mining stocks. So I wondered if you could go over the data that we looked at before just briefly and explain why you decided to dig deeper into it.
Okay. I found about 6 weeks ago, I think, some information that analyzed the relationship between the gold price and the XAU index. And it started with the time frame of 2000 to 2008. And the data indicated that during that time, the XAU price divided by the gold price, that it was about 22%. And it was pretty stable through that entire time frame. And then between 2008 and 2016, there was a very tumultuous period, and that ratio went from 22% all the way down to 7%. And then in 2016 to 22, that period was quite stable at about 7%. Well, I looked at that and I said, well, what in the world is going on here? I had no idea that that particular period of time was such a dramatic shift in what was going on. And that started me on the path of researching all of that. And so then what I did after that was try to break those periods down in detail. So I went to the internet and I found the price histories for gold, all from 2000 to 2022. Also the prices of the XAU index. And I used that one because it was the only one that dated all the way back to 2000. So I had a complete coverage, and that was what was in the data that I had just mentioned. And so then when I also needed to know was the all-in sustaining cost, because that would give me the gross margin. And I had to work hard to find that. And I got, I think, the best numbers I could. I think they're okay. And then I would take the gross margin from the gold price at that particular point in time, and that gave me a gross margin. And then I was comparing that to the XAU's performance. What I learned there was that, yes, the gold price, in fact, in 2000 to 2008, went from $300 to $800. The all-in sustaining cost went from 150 to 400. Gross margin, 150 to 400. The XAU from 60 to 160. So all of those actually increased about the same, about 160 some percent. So that was consistent with that earlier data that said, well, yeah, the XAU divided by the gold is about 22%, and it's consistent all the way through. Then we got to the 2008 to 2016 period, and during that time, gold went up 56% by my data, and those are approximate numbers. Realizing I'm looking at an individual year, like 2000, and then looking at the price history and basically eyeballing what looks like an average. So these numbers are approximate, but that's the best I could do. And it seems to fit most everything, looks right. So that the gold went up 56%, but the XAU went down 47%. And the reason for that was that the all sustaining cost went from $400 to $1,000. So it went up 150%. So obviously there was a really large increase in the cost of production during that period of time. And then when we get to the next period, 2016 to 22, we saw the gold price was up 44% and the XAU was up 53%. So again, that made sense in terms of then saying, well, yes, the 7% would have been stable because they were pretty close. They tracked each other. And the thing that I did notice, though, also is, of course, the relationship between the gross margin and the XAU. Profits and the share price ought to track together. And during that first period, they did, right on. And in the second period also, the gross margin was down about 40% and the XAU was down 47%. So that made sense. So the numbers were adding up in terms of what you would expect to see. Then in the third period, the thing that was strange to me was that the gold price went up 44%. I said the XAU went up 53, but the gross margin actually went up 140%. In fact, I actually have a mistake on what I gave you. The gross margin in 2022 was actually 600, not 500, but I made a little mistake there. But so anyway, there's a big discrepancy at that point between the gross margin and the share price. That doesn't make sense to me. And I have yet to be able to figure that one out. The enormous increase in cost, all-in sustaining cost in the 2008-16 period, I am attributing to a dramatic decline in the ore grade that's being mined by the mining industry. I have no hard evidence for that. Nobody really keeps track of that, particularly on an industry-wide basis, and individual companies do. But that's really the only thing that could make that much of a difference. Because, of course, if a company is mining ore at 2 grams per ton and it goes down 1 gram per ton, well, all the costs go up by 100%. And so, that's an enormous issue. And we're always seeing changes in terms of how many high-grade underground mines are operating, how many open-pit heap leach that are much lower grade are operating, and how they come and go. And we also know that, particularly when times are hard, which was the case in 2008 and 16, what the companies would do was they would actually initially mine the highest grade ore, and then what's left is the lower grade. And so you had that kind of thing going on as well. So that's the best I can do at this point. I've talked to a lot of people, and everybody just looks at me, well, I don't know. I didn't even know that happened. So it's very interesting to see that. But what it dramatized to me is the importance of investors, if you're going to invest in producers, keeping track of what the costs are doing, because it's a huge deal.
Yeah. And so you basically you took that short-term data, you expanded it to the long-term. Mostly you validated the conclusions that you talked about last time. Some questions remaining, which as we were emailing about before this interview, maybe somebody in our audience, they could write in if they have some ideas about why these things are happening. Yeah. So this is really good. And I think, of course, we'll have all the charts up for everybody. They can look at it. You also recently shared with me some data from CIBC covering PE ratios, all-in sustaining costs for gold producers. I know that you also want to go into what you're seeing there, so I'll let you start off down that path if you'd like to.
Sure. My friend Doug Ramshaw, the president of Minera Alamos, who is a wonderful executive and my favorite junior producers, by the way, give him a plug. He helps me a lot, and it's been a good relationship. He provided me with bank data from CIBC Bank, Canadian bank. I'm not familiar with it. You probably are. And what I found there was the price earnings ratios for a group of gold producers. And what I was surprised at was that the PE ratios for them was in the low 20s. And the interesting thing is that the current PE ratios for the S&P 500 is about 24. So it wasn't that much different, which tells me that the gold producers don't appear to be all that undervalued. And that I don't understand, particularly in view of the number that I just mentioned to you about what the gross margin did in the 2016 to 22 period should have resulted in a much higher XAU number, but did not. So I still haven't figured that out. And I've also talked to Doug about that, and he says, I don't know how to explain that either. So I kind of keep digging to understand it. So there's something going on there. One of the possible explanations, of course, is that all-in sustaining costs do not include G&A and taxes. And the G&A, of course, is accounting and marketing and all manner of things like that. And, of course, taxes is what the government of the local, wherever the mine's located, is taken out, plus the income and everything like that. So, and that kind of thing has probably been going up in recent years, with mining companies trying to be better stewards and countries trying to get more money for the locals to buy their votes and whatever, And so there's certainly some of that going on. How you quantify that, I have no clue. But I know that that's something that's happening. out there. So anyway, I'll try to learn some more about that. If anyone in the audience has any inklings regarding that, that might explain why what I thought was going to happen with the share prices at the end there in 2016-22 didn't materialize when I look at the PE ratios. Now, I realize they weren't a lot of companies in there, but enough that it should have given, because they were the representative ones, that it should have been made some more sense than it apparently did. But there was some other things about the data that he sent me. Also the PE ratio on the royalties was 45, and that's not a surprise, and I'll explain why when we get to discussing that. But the other thing that's really good news in terms of cost is that the CIBC data confirmed what I had seen on corporate presentations, that the cost of production, the all-in sustaining cost number, is around $1,200 per ounce right now, and they expect that to be the case for 2023 and 24. So the cost's pretty stable. So that's wonderful news, because that means if we get a good bump in the gold price, then all that's going to go to the bottom line. And so we gold and share investors should do very well if we get the kind of increase in the gold price that I think we could in the next year and a half or so. I would see $24 an ounce, $100 an ounce by the end of next year as quite a likely occurrence. But we won't get into that. That's all another subject of another interview.
Yeah, I was going to say, as you're talking about this, one thing that I thought is, you can argue about whether the gold stocks are undervalued or not, but they do still have that leverage. And we have a whole nother interview on that if people want to go learn about that. But maybe that's a good takeaway that people should remember.
Yes.
All right. So you mentioned royalty companies, and I know you've been doing a lot of work among the royalty companies right now that has led to some interesting conclusions for you. So I'm hoping we can pick up on that as well and learn about what your findings are there, because this is going to be quite interesting for investors, I think.
I would love to. Okay, what I learned, I wanted to know what the royalty companies did in relation to the gold price. And so for the 2008-2016 period, because I keep working with, I didn't go back because the royalty companies were operating in that earlier decade. Okay, so I started 2008-2016. Gold was up 56%. Franco-Nevada was up 200%. Royal Gold was up 71%. Wheat and precious metals 67%. These are the big players that matter. Then 2016 to 2022, gold was up 44%. Franco-Nevada was up 133. Royal Gold up 83%. Wheat and precious metals 100%. In other words, they did not only well when the shares were doing well in the recent period here, 2016-22, but in the 2008-2016 period, when the producers' shares were down 50%, here you had Franco-Nevada up 200. Royal Gold up 71. We're reading President 67. I did not expect that. I did not expect that. And that told me a lot about the value of investing in the royalty companies. And I also am reminded, because I've been investing a long enough time, I remembered the reason why the royalty companies are capable of making outside gains on the gold price. And that is when they do deals. Basically, the royalty companies are banks. They're investment banks. They lend money. They don't have factories. They don't have fixed assets or anything. And so they make a deal with a company that wants to build a mine to produce 100,000 ounces a year. And then they get a royalty that would be 5% of the revenue or 5% of the gold that they would then receive. And then they would sell that and get sold the same thing. You're tied to, obviously, the gold price. But the way those deals work is that the royalty company gets the percentage of everything that's produced at that mine site in the future. So if you get the right company and they go from producing 100,000 ounces to 300,000 ounces, they get 5% of the 300,000. And then, and that's true ad infinitum as long as the mine lasts. You just think about that for a minute, what a tremendous compounding that is. And the marvelous thing with the royalty companies is that their pre-tax profit as a percent of sales is like 75 or 80%. It's like software companies. So they print money. And then when they take all that cash flow, they do new deals. They don't have to borrow any money because they've got so much of it. And they pay dividends because they've got lots to share. And they do all of that without being vulnerable to cost increases or all the other hazards and things that can happen to a gold producer. So you have lower risk and yet a really good upside. So I'm recommending that we advise investors have a significant position in the royalties, which is Franco-Nevada, Royal Gold, and Wheaton Precious Metals. They're the bigger ones. They've been around longer, but why it's good to buy the ones that are bigger and around longer is because they've been able to buy into deals and have those deals grow, so that then they've got all this. And whereas the newer ones, maybe they will, but they're not going to have been able to take advantage of that and the situation for 5-10 years, maybe. So it's really, I think, an interesting thing. And I wasn't aware. I knew the royalty companies were good. I didn't know they were that good.
Well, and I think a lot of people might be in that same position of like, oh, yeah, I've been told to look at royalty companies, but maybe they find them a little bit boring. But I think it's great to have the numbers like you've shown us, because that really
kind of boring that every investor should hope for. I mean, you can go in the excitement of the explorers, but then, you don't sleep well because, you can lose all kinds of money. You get diluted to oblivion and whatever. The royalty companies don't issue any stock. They don't dilute anybody, and they pay a dividend, for heaven's sakes. So, it's really a marvelous investment vehicle. And so when we get into later talking about a recommendation for portfolio, I want to share that, and well as the fact that I personally have decided to allocate more money to the royalties.
Well, and I think, yeah, we could go into that, because not only do you do all of this research, which a lot of people don't have the time or maybe the patience to be doing, you actually are willing to tell us what you're doing with your portfolio and how you've taken these numbers into something actionable. So maybe we could talk about that.
Yes. Well, I wanted to tell you about one more thing that I learned recently that I hadn't maybe talked about. I've been working with these indexes as a proxy for what the share prices of the producers are doing, right? And there's really 4 of them, the GDX and the GDXJ, which are run by a company called Van Eck. And then there's the XAU and the HUI, okay? All 4 different ones. Well, I naively assumed up to now that they were all pretty much going along the same. That isn't true either. That's just another aha. In fact, between 2016 and 2022, GDXJ went up 17% during that 6 years. GDXJ was up 21%. XAU was up 62%. And the HUI was up 50. In other words, 2.5 times better. I don't recommend people buy ETFs anyway, but if you're going to, you sure heck ought to look at the history of what they've done. And now why there's such a huge difference between the first 2 and the other 2, I have no idea. I just ran across that. But again, because I'm always interested in digging in and seeing, asking myself questions and then seeing what I get, that was another surprise. I would have never guessed that either. So just for anybody who's looking at ETFs, you're gonna get into it. You should take a serious look at what you're buying, because they ain't all the same.
Yeah, well, and that's a great point, because people are often told, well, if you're not really sure what to do, maybe you go for an ETF. But there are these differences, as you said, there are expenses. Exactly. So very interesting. The
other absolute disadvantage to the ETFs is that they have a wide swath of companies. They have the really good and the not so good. And my feeling is, I don't want to buy the not so good. I'm going to be selective and do better. And yet with the ETFs, you're stuck with everybody. And so that's why I never recommend them. But for people thinking about that, I would discourage them at the very least from focusing on the GDX to GDXJ.
Yeah, those are very interesting points. And maybe that's a good way to go in the direction of what you are liking right now. So we know that you like the royalties, don't like ETFs. What else is in the pile of things that you're feeling positive about? Well,
let me give you a portfolio that I would recommend for most people. And I did send that to you. I made one change to that since, and I'll tell you what that is. But for the low risk gold silver portfolio for people, I would recommend gold bullion, 20%. I own Canadian maples. Those are my favorites. And that's all I own in that. and then silver bullion to another 20%. Because you want to be there. You must believe that the gold and silver prices are going to go up. You wouldn't be listening to this interview to begin with. And so that's pretty much there. For the royalty companies, I would recommend 30%. And that's much higher than I had previously thought. But as I look at more and more carefully, particularly for a conservative investor who wants to get some profit from their belief in the improvement in gold and silver prices, they should obviously be there, and they're going to do better than the bullion prices. We already saw that from what's been happening historically, and it should continue. Then I'm having another category here, that of producers, which would be 30% of what remains. And I'm going to change what I said to you, and what I said major producers. The truth is there was only one major in that group, and that was Agnico. I think that's too big. They're a $25 billion company. It's a wonderful company, but it's really hard to grow 2 or 3 times your market cap when you already started at $25 billion as in a mining business. So I'm suggesting we focus on what I call the mid-tier producers, and that's companies in the range of $1 billion to $10 billion market cap. Okay, there's a lot more in that lower range where they can grow 3 times, and that is an unusual expectation. So I have 2 companies that I would recommend. One of them is Alamos Gold, and I'm suggesting 7.5% for that one. And the other one is called K92 Mining, and another 7.5% for that one. Those both have good growth potential and stability, and they're very good. Then in the silver sector, I recommend Aya Gold and Silver, 7.5%, and Silvercrest Mines, 7.5%. And that makes 100% for the basically low-risk portfolio.
You know, it's not often that we get such a clear breakdown of a portfolio. So I think that should be very helpful for people. They can model their own portfolio off that if they don't want to follow you exactly, because everyone should do their own research, of course. But I think that's very helpful for everybody.
Good. In subsequent interviews, I can talk more about what I would consider a more moderate risk portfolio and add some junior producers that I like Minera Alamos, as well as developers and explorers, because I invest in that because I think I can be selective enough that I won't end up losing money on the deal. But what I've just suggested is for people who don't want to take the time or have the interest to dig in, because if you're going to be selective, that means you have to do some research and really study it. And then it's also a focused portfolio, because the other thing I always advise people, don't really have any more than 10 positions. And that is exclusive of royalties. Royalties and bullion are in a separate category. The producers and explorers and all that, so that no more than 10 in that group, because you can't really follow closely what they're doing and keep track of whether the reason why you bought them is actually being achieved. And so you need to keep track of that. And so that's why in investing in the producers, I see that as a separate category, but I don't want to see people getting too many, because you end up basically not paying attention and stuff happens and all of a sudden, oh, gee, what happened there?
Yeah, I think it can be easy to get too enthusiastic by too many companies, and then you lose track of them and it just gets messy. So that makes
they're all marketing, because all these producers are competing with each other for the investment dollar. And so you got to expect that. They're going to try to sell you, that lemons are lemonade, and you have to be selective.
I think that's very true. And okay, so I have a question maybe as we're just wrapping up here about what's going on in the overall gold market right now, because we've seen gold spend a good chunk of time this year above 2,000 per ounce. I know you have a long-term view, but we are we're below 2,000 again right now as we speak. And I just thought you might have some advice for investors on how you stay calm and focused during these times when we might have pullbacks. How do you do that?
Well, I think, first of all, I have lived long enough and seen enough to realize that fundamentals always win. Fundamentals always win. So then you have to have really a clear idea of what you believe the fundamentals are and what they're telling you. And if you do that, and you believe, as I do, that the macroeconomic scene is such that gold and silver are going to do very well because gold is inversely related to people's confidence in the financial system. And we have a lot of things going on that are causing people, because of debt levels and all sorts of other things that argue, money printing, debasement of currencies. That's all happening. And we know historically that we go through these cycles, and we're in what the Strauss and Howe called the fourth turning, where we are in a period of upset, and all the debt that's been built up is not going to be sustainable, mainly because it can't service it at higher interest rates. So all these problems occur. So gold and silver, the fundamentals are the gold and silver is going to go up. It's going to go up. So as long as you believe that, then you look at what's going on day to day and say, well, you know what, that's just noise. That isn't, Warren Buffett said that basically the stock market is a voting machine, but the value is a weighing machine. It's what's really there. And so if you analyze your companies and your situation and you said, the value is really there and the trend is my friend, because I believe the fundamentals are what they are, then you should sleep well. I mean, it's just like with individual stocks, they're even more volatile than the gold price. But the thing that so many friends of mine get upset about is they say, oh, my, it went up or down 10% today. Yeah, but you ask yourself, what was the trading volume? Because, if the trading volume is well below average, it's nothing. The only time you want to be concerned is if the trading volume is way above the average. And the Yahoo Finance keeps track of that. When you look at something, it's got the average trading volume. You look at that and say, well, wait, it's way up. Then what, you start calling the IR department of the company and you look at start digging. And so that's when you want to pay attention to something that you see shifting, and particularly with your individual companies, is watch the trading volume.
Okay, you make it sound very simple when you lay it out like that. I know it can get tricky for people, but if they go back to those words, hopefully that can help sort them out. I think that we've been through, yeah?
The reality is that it's really important not to let your emotions guide your investment decisions. You need to use your left brain on that and just look at the numbers and examine why you did what you did, and then say, oh, okay, and relax about it. I know that's easy to say, but that's also why I mentioned to you in the first interview that people should not get invested in this sector unless they have all their debts paid. So they have no worries then. So, you got all your debts paid, then you're much, much less likely. So I reemphasize that, and I hope people will take that to heart, because that's one of the ways not to get emotional, because you can get emotional if you've got lots of bills and a mortgage and car payments and blah, 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 blah. And then you're going to invest in the gold and silver mining. No, you shouldn't be doing that.
Yeah, that's a good reminder. Good to come back to that point. Is there anything else you have on your mind right now that you want to share with the audience?
Well, no, I think I'm just going to keep asking questions and digging into things. And I will be interested in sharing about some of the other companies that I own that are not in the low risk portfolio, and I can tell you about them. And that's, I think, something of interest. So, yeah, hopefully we can do it again.
I hope so. I think definitely we should come back to those other types of portfolios. We've got the low risk one for now, but then we can look at your other options that you have for people. Yes. That's really good. So I think we'll leave it there for now. This was a nice, I think, wrap up of the things that you're looking at right now. Thank you again so much for sharing.
Oh, it's my pleasure, Charlotte. Thank you for having me.
Really great to have you. Thank you for coming. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Don Hansen.